A new report from the Canada Mortgage and Housing Corporation has raised a significant concern for the housing market in Ontario and across Canada. It warns that over 1 million homeowners will face substantially higher interest rates when their mortgages come up for renewal in 2025. This situation arises because approximately 85% of these fixed-rate mortgages were initially secured when the Bank of Canada's rate was at or below 1%. In stark contrast, the current rate stands at 3.75%, which is a significant increase that could impact many homeowners. The report highlights an approaching wave of renewals, with 1.2 million fixed-rate mortgages due in 2025 and another 980,000 in 2026. Economist Michael Davenport from Oxford Economics predicts that this could lead to an increase in housing market listings. Homeowners who are financially stressed might opt to sell their properties, particularly in late 2024 and early 2025. However, he also notes that loosening mortgage guidelines and potentially lower interest rates should boost housing demand by mid-2025. There are already warning signs in the private lending sector, where mortgage defaults and foreclosures are on the rise. In the second quarter of 2024, the delinquency rate for single-family homes surged to 5% from 1.7% in late 2022. Foreclosures have also increased to 3.5% from 1.3%. Tanya Barasa Ochoa, the Deputy Chief Economist at the Canada Mortgage and Housing Corporation, notes that the tight and liquid real estate market, especially in Toronto, offers struggling homeowners the option to sell before facing foreclosure. She emphasizes that higher living costs and increased debt servicing expenses have significantly impacted household budgets, creating considerable vulnerability for homeowners. While the overall mortgage delinquency rate has risen to 0.19%, it remains below the pre-pandemic level of 0.28%. However, other forms of debt, such as credit cards, car loans, and lines of credit, typically show stress first, serving as leading indicators for future mortgage delinquencies. On a brighter note, the Bank of Canada has implemented 4 consecutive rate cuts, bringing the key interest rate down from 5% to 3.75%, with another reduction expected this year. According to Davenport, this rapid rate-cutting cycle may help prevent a sharp increase in defaults and avert a potential deep recession. It's a complex situation, and as always, it's crucial for homeowners and investors to stay informed and consider all factors when making decisions. Today, we are diving into an insightful discussion led by Senior Deputy Governor Carolyn Rogers of the Bank of Canada. Recently, Rogers addressed the Economic Club of Canada, offering a comprehensive overview of the current state of the Canadian mortgage market. It's an interesting time to revisit this topic, especially after the past 5 years that have seen a global pandemic, a dramatic economic downturn, and a subsequent rapid recovery. These events have significantly influenced Canada's mortgage landscape. Rogers emphasized that while inflation has returned to the Bank of Canada's target of 2%, the cost of living, particularly housing, remains elevated compared to pre-pandemic levels. This is a crucial concern as housing expenses form a significant portion of household budgets. For those with mortgages, the elevated interest rates, which were necessary to curb inflation, mean that many Canadians will face higher payments upon renewal in the coming years. The Bank of Canada is keenly observing this scenario from 2 perspectives. On one hand, there's the monetary policy angle, where increased shelter costs could lead households to reduce spending in other areas, potentially impacting economic growth. On the other hand, there's the financial stability perspective, which involves ensuring that the financial system can withstand potential stress from increased mortgage payments. Rogers also highlighted that interest rates have started to decline, with further normalization anticipated. This indicates a promising path forward, as lower rates could ease the burden on homeowners when they renew their mortgages. The Bank of Canada remains committed to balancing these dynamics to support both economic recovery and financial stability. In conclusion, while the path has been challenging, the efforts to stabilize inflation and manage interest rates seem to be paying off. It's a delicate balance, one that requires careful monitoring and adjustment. As always, staying informed and prepared is key for homeowners and investors navigating these changing times. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit Real Approved Kia to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.